So hello everyone and welcome along to this live webinar. And today I'm joined by Daniel Foch. And in this webinar, basically, the main topic is deal analysis, property deal analysis. Hi Daniel, how are you?
Sorry, I was muted there. Yeah, I'm fantastic. How are you doing? Thanks for having me.
Great. Pleasure to have you here. Daniel, perhaps you can start with a brief introduction about you for the people that don't know you yet.
Yeah, absolutely. My name's Daniel Foch. I'm a real estate broker and host of the Canadian Real Estate Investor Podcast. My current job and mandate is to educate the next generation of real estate investors, especially millennials. And millennials for the most part have been sort of marginalized by the real estate investment market for the past several years as house prices accelerated for 25 years straight here in Canada, basically. And right now, given that we're seeing a bit of a counter cycle happening, I think that this is really going to present once in a lifetime buying opportunities for millennials. And I want to, as part of the podcast, as part of our mission, is really to give millennials the tools that we need to, and not just millennials, but anybody who is interested in investing over the next couple of years, the tools that we need to capitalize on the opportunities that are in the market right now. One of the things that we mentioned on the podcast a lot is you have to be looking at hundreds of deals before you find a good one. And you can't do that using a spreadsheet or a pen and paper. And so, the reason that we partnered with you at Lendlord is because you've given that tool to all of our listeners to go through and use this deal analyzer tool as well as the property management platform to become better investors. So we're just excited to give everybody this webinar on how to maximize that tool. So thanks for your time.
Thank you. Yes. Yes, sounds great. And let's go over the agenda for today. So we will do live analysis of rental property, and then we'll use the flip analyzer to see what results we can get instead of letting this property out just to flip it. And flip, I mean, buy the property, make some improvements, and then sell it. Then we speak about some best practices, how to source properties, and best practices, how to analyze property deals in this current market environment. And then in the end, we'll have session for questions and answers. So feel free to ask questions in the chat, and then in the end, we can answer. And if it's related to what we are demoing, Oriel and Daryl will ask the question, and we can answer live. Danny, I thought that perhaps just for the people that don't know Lendlord yet, I will give like very high level overview on the platform.
Yeah, absolutely.
So Lendlord is a platform for property investors and landlords. So it basically we separate the functionalities into three main sections. The first one is invest. So we help property investors or existing landlords to invest better using the deal analyzer that we will demo in this webinar, or using the flip analyzer. On the manage section of the platform, you can manage your existing properties, but also you can manage a prospect pipeline. So you have the My Portfolio page. This is the place to put the details of all of your existing properties, manage the data, upload documents, customize different views, and filter by different filters. It can be by owner, or it can be by the type of ownership, etc. We did a webinar on this part, and perhaps we'll do like another one soon. You can also manage your tenants and tenancies. You can track your rent collection, and you can also manage your cash flow. And cash flow means to review your profit and loss, the income and expenses of each property or segment of your portfolio. You can use the transactions page and link your bank account. By linking your bank account, you will get a live feed of your bank transactions, and you can allocate them to the relevant properties. And you can also generate some reports. The third section is the finance, and this is something that we are still working on the Canadian version, but here you can basically look for mortgage options and soon also bridging finance. The fourth section is the buy and sell. This is also something new, and here Landlord will collaborate. It's still just launched. We are going to collaborate with agents and get some exclusive properties so you can review the property and also make an online offer. And for the sake of this webinar, we'll start with the deal analyzer. So Daniel, let's start with the first example and try to analyze them together. So I think this is the link. So okay. You want to say like a few words about this property before we start?
Yeah, for sure. I can go over it just because the description hasn't updated properly on realtor.ca. So quickly, it's a mixed use building in East York area of Toronto. Has a ground floor commercial unit with 4 residential units above it. It's located sort of in a central shopping district. It has a ground floor retailer that is a salon and spa. All long-term tenants, so the rents are underperforming quite a bit. So we're going to use it as both a long-term analysis, but also as a flip, because I think if you could, give cash for keys to some of the tenants, so buy them out of their leases and then rehab the suites, you could actually likely double almost all of the rents in the property. So it's the lot size is 2,470 square feet. And it's got just 21 feet of frontage. So it's an old high street property in the Coxwell area of Toronto, or East York area of Toronto. So it has the 4 residential units are 2 bedrooms and 2 1-bedrooms. So unit 1 is a 2-bedroom making $1,425 a month. Unit 2 is a 2-bedroom making $1,600 a month. Unit 3 is a 1-bedroom making $970 a month, and unit 4 is a 1-bedroom making just $600 a month, which is wild. You'll never see that rent in Toronto ever again. I don't even think you can get a bedroom for that there. And then the commercial ground floor commercial makes $2,900 a month plus HST. So the total monthly income is $7,495 before HST, and that's net. So fortunately, it'll be easy to model from an expense perspective because there are individual power, electricity, and gas meters on all of the units. So there's probably a small expense for common area for the landlord, but it wouldn't be like where you have to model the utilities for each individual unit. So annualized, that's just shy of $90,000 a year. It's $89,940 per year.
All right. So let's start. So first I will go to the deal analyzer. We'll put the address. Okay, so the first section of the deal analyzer is the purchase details. And here, basically, we just need to put 2 data items, and then the platform with its defaults will generate the first year metrics and the long-term metrics. And then from this point, we'll start to tweak the data. So can I take the purchase price from here, or you think you can purchase this in a different price?
Yeah, I would expect that it'll probably transact closer to 2 million. So maybe put in 2 million to get a rounder number there.
All right. And the expected monthly rent?
I think we had it at, I think it was $74.95.
$74.95. All right. And do you estimate the current value as this like a higher number than the 2 million, or should
it's probably around 2 million.
Okay, so there is no difference between the purchase price and property value. All right. So you can see that the platform already generated the first year metrics and long-term metrics, but now we will start to tweak the data to see the real result. So the platform calculates the land transfer tax based on the area, but you can tweak this number, of course. And if you're a first-time buyer, the number will be a bit different. Improvement costs. So this example is we are going to rent this property and hold it for 10 or more years. So do you think you are going to do some kind of improvements, renovation, furnishing, other costs?
Yeah, in this, I guess there would be two different scenarios, and maybe we can use, like, when we were talking prior about doing a base case versus a best case kind of thing. I think, there would be a scenario in which if you were to spend, let's say $100,000 on renovating 2 suites and also paying out cash for keys to the 2 tenants, especially in those 1 bedrooms that are well below market value. So, if you're to assume you had to pay $5,000 or $10,000 to each of those units. So let's, you can include that.
Let's put 15 all in all.
Sure. Yeah. And but then, you're going to increase your rents to, I would say you're probably able to double at least, the 900 rent and probably triple the 600 rent. So you're increasing your rents to, your monthly rent to 9,525. So you can 9,500, and you can see that brings the cap rate up to what would be reflective of the Toronto market for an asset like this. I think right now you're kind of seeing Toronto in a 4.5 to 5% cap rate range.
And Daniel, I think also perhaps the property value will also increase in the short term. No,
definitely, yeah, for sure. I would say you've probably. Yeah, I'd say probably, like, in the market right now, you're seeing at least a 50% increase on any capital, like CapEx, that you're putting into a property. So if you're putting in 100K, I would say even 150, or you could even make it 2.2 million probably.
Like this. All right. Okay. Now let's speak about leveraging this deal. So I believe that you will take a mortgage to finance this purchase.
Yeah, I would recommend it. And I think that's probably good. Like a 30% down payment makes sense, given, if you saw before we did the renovations, the cash on cash was negative, and I typically don't advise people to purchase for cash negative investments. So I would I'd probably keep it there. I wouldn't go too much higher on the leverage point.
All right. And something that is important to emphasize, the difference between the cash investment and the deposit. So if you say like 36% cash investment, means that is out of the total purchase costs. So it includes the renovation that we are going to do. It included the transfer tax and the closing costs that actually we also need to adjust. So you have how much you will pay on legal fees?
Probably 1,500.
Appraiser cost?
Probably 750.
And the title insurance?
So that's built into the legals.
Okay. Property insurance?
Probably $3,000 a year.
So we'll put it on the monthly operating cost, not here.
Yeah.
Okay. And the municipal land transfer tax also calculated based on the location. Does it sound reasonable for you?
I think so. It could actually be double that. I have to see, like, is that because because it's in Toronto, there's both municipal and provincial.
Okay. So you have the land transfer tax, and then on top of that, the municipal land transfer tax.
Right. Yeah. So the double, yeah, it looks like the double's in there. You're good.
All right. So the cash investment basically is to cover. So the 36% is out of the entire purchase details, while the 30% deposit is, we take it, from the purchase price. So you will need to put down around 788K. And this is the loan amount. You will take it for 30 years.
Yeah, I think probably 25-year AM might be a little bit more realistic.
25. It will take our monthly mortgage payment up, of course.
Yeah.
The current market rates, I would say 5% makes sense.
Yeah, I think 5%'s it's ambitious, but it's probably good. You could probably pull that off on this type of asset.
And the repayment method will be principal interest. In the UK, by the way, you can see many mortgages that just interest only. So it basically your cash on the net cash for every month will be higher, but it will not increase your equity year over year. So I believe here, like the default will be principal and interest together. Yes.
Yeah, that's the typical debt structure for term debt in Canada. Interest only, we'll see, like maybe when we're analyzing it as a flip, we can think about an interest only mortgage. It's more, you see it more in those types of situations.
Right. All right. Mortgage fees, an estimation on how much this will cost.
It's typically built in. So there's typically like a 1% broker fee, but it's usually built into the mortgage for any bank facility. You're typically not paying. So I wouldn't add that in as a cost. Yeah.
Right. So let's leave it like this for now. Then you have the annually operating expenses. So you basically have the property taxes. I think that we saw it.
Yeah, they're around 11,000. Yeah.
Yes. Okay. So let's take this number. And this is something that you will need to pay every year.
Yeah.
Yes. Okay. So our deal analyzer will take it into account when calculates your long-term metrics. Okay. Monthly operating expenses. Are you going to use a managing agent?
I don't think you would really need to for a deal of this size. Like it's a small enough property. Like the owner currently manages the property and has no problem at all. It's only 5 units in total, and the commercial is triple net, so they pay all of their maintenance and insurance expenses, and then everybody pays their own expenses as well. So there shouldn't be any issues there.
All right, landlord insurance for the property.
I think about 3,000 a year would be reasonable.
Okay, so it's $250 a month. Any other costs on a monthly basis? Utilities, maintenance?
Yeah, maybe like I would put in $100 for utilities just for the common areas, but it shouldn't be much more than that. And then maybe a small maintenance fee, like $250 a month or something, just for anything that comes up.
All right. Okay. So before we take a look on the metrics, then let's put some assumptions for the long term.
Yeah.
So here, first, you have the occupancy rate. So the default is 95%.
I would probably, I mean, I think you could even do it lower than that, given Toronto multifamily occupancy. Well, Toronto's occupancy rate's like below 1% right now, or vacancy rate, sorry, is below 1%. So occupancy could be, you could go up with that. You go to like 99. Okay. Yeah, my apologies. Yeah.
All right. 92, by the way, it means like 1 month every year the property will be empty.
Yeah.
Okay. Then let's do like different scenarios. So let's start with a standard one. The occupancy rate, let's put 99. Like in a reasonable market, what would you say? With your property appreciation?
So historically, since 1984, Toronto property values have grown at about 6.11%. So you can put that in, or 6%.
Let's put 6. Rent appreciation.
So rents are capped on the Ontario market at inflation. So I would just put it in at maybe 1.5 right now. I think it's 2%, but historically it would be closer to 1.5 or 2%.
And inflation in Canada, what do you say, like for the next 10 years? It's very hard to predict.
Yeah, I mean, right now it's running hot. I would say probably for the next 10 years, we're going to be looking at like a 4% inflation. If you were to average it out, I think we're going to be in for a pretty inflationary decade here.
Makes sense. All right, then let's do the best case scenario. I click here on edit. So occupancy rate, let's put 100. Annual property appreciation for best case, let's take it 7, 8. Best case scenario.
Yeah, best case probably 7, 8. Yeah.
Let's put 8. So the cap will cap it to 2%. You say the rent appreciation.
Yeah.
And I would put inflation at 3%. This is of course the best case scenario. And then let's put the worst case scenario. In here, what do you say? Occupancy 92.
Yeah, that would be if you get one. If you're losing a month a year, that'd probably be the worst you could possibly see in Toronto.
Annual property appreciation, the worst case scenario.
Yeah, maybe 2%. If it's growing at inflation or below inflation, would be pretty bad.
Right. Right, I put like 1.5. Hey,
Yeah, you could
0.5.
put even, yeah, put it at 1 or whatever, because that would basically just mean that your tenants refuse to accept the rental increases that are legally allowed.
All right. And this is really worst case scenario, 8% a year inflation. Let's put 6. I don't know.
Who knows? They don't seem to be
Right.
getting it under control over here. Could
Yes.
happen.
By the way, the inflation on the deal analyzer will impact the cost side. So basically, it will be linked to the inflation rate. Okay. So now let's start with the standard scenario. So what do you say about the metrics, the cap rate? So you see like
Mhm.
by the way, there will be a negative cash flow in the first year. As you can see, basically you will lose $400 every month.
Yeah.
But the cap rate looks reasonable.
Yeah, it's okay. I mean, that's a Toronto cap rate. I think, the cash on cash being negative or close to zero, like I don't love that. I'd love to see a positive cash on cash, obviously. But I think there are ways like in our improvement cost scenario, we only bought out 2 of the suites. Like you could potentially double the income of all of these suites if you did cash for keys on all of them. So there are scenarios in which you could make the asset perform better on a cash basis. I'd like to see it, like if I was representing a purchaser on this asset, I'd like to see it purchased at, somewhere above a 5% cap rate. And then the upside potential of, spending 100 or 150,000 on renovations of all of the suites, buying out all of the suites. And even, the commercial lease is coming up for renewal. So maybe modeling in getting a tenant at a higher rate on that in a couple of years as well. So there's definitely upside potential, but I don't think that, it's
And
not super compelling from my perspective based on those metrics right now.
but I think that we are very close to break even. So you just need to raise the income by $500 a month. So let's say if it's okay, then you start
Mhm.
positive. So you just need to increase
Yeah.
the rent in order to get positive cash flow.
Yeah.
Then let's take a look on the long term. We analyzed for 10 years. Would you take it to 15 or 20 years?
Yeah, I think that you'd probably want to hold this for like it's in an area of Toronto that's really up and coming. They're starting to see some density there. The suburbanization of Toronto is happening a lot there. I would probably hold this for minimum 15 to 20 years. So,
All right. So let's just for the example put 15. So the long-term ROI takes, of course, also the property appreciation based on this scenario. The IRR is the internal rate of return. So basically it takes into account also the appreciation of the property value, and it's 12%. It's quite good. And there are other relevant metrics that you should look when you buy the equity multiple. And also the equity in the end of the period is basically $4.5 million in this scenario. But if we take the worst case scenario, then of course the numbers will go down. But we'll still, like, even with 2% annual property appreciation, by the end of the term, the IRR is, I think if you compare it to the inflation, is not so good right now, but you still like get a nice return on the deal. And if we take it to the best case scenario, the numbers, of course, are much better. So another thing that you can do with Lendlord is to go to the prospect report, and then you get a summary of the deal, and you can see the development of your equity and based on the assumption. So I
yeah.
think this is the best case scenario. Let's take it to the standard.
Yeah. And I really like that tool. Like I use that a lot with clients when I'm analyzing deals, and I'll just send this off to them. Like I'll plug in a couple of different scenarios and I'll email them the PDFs that come from these.
Yeah, you
It's
can see
been
that
really
the
good.
equity, so the mortgage balance will go down because you basically repay the principal, and the equity will go up, and also your net cash flow will also go up because of the rent appreciation, and but also it also takes into account the inflation. All right. So by the way, would you purchase this property based on these metrics?
Myself, I probably would. I feel like I'd like to see it at a bit of a sharper price, like either increase the rents, or if you could get it to that 5 cap that you had at 10K a month, then I think it'd be compelling for me.
Like this, yes.
Yeah, I like it. Like I like it more there, or maybe even if you bring the rent back to the 95, 25, and we can see what price at which I could get it at a 5 cap, right? Like if we reduce the price maybe to 1.9.
Yeah. Then
Closer, right? So 1.8, 1.9, I think.
okay. So it's good, for you, like if you want to, if this is like, if you are targeting 5% cap rate,
Mm-hmm.
you know where you should put your price, and basically what is the expected income.
Yeah, it's interesting in this situation too, because I've been through all of these numbers with my client with this analysis, going through the situation saying, I know there's investors in the market right now looking for 5%. So we either need to, sell this with 2 of the suites vacant potentially, right? So that they can come in and realize those new rents. And then he can increase if he wants to get that price of 2 million rather than somebody paying 1.8 or 1.9, right?
Yeah. Right. And last thing I would do, I click on the save button. So the save will save this prospect, and the place I can review it is on my portfolio. What I need to do is I'm going to deselect the existing properties and then use this drop down. And basically here are the details. I can use the views button to change it to performance view, and you can see here the metrics from the deal analyzer. And of course, if I have another property in my pipeline, I can compare the metrics of 2 different properties. And if I want to go back to the deal analyzer, I just need to hover over the property row, click on the deal analyzer, and be again in the deal analyzer for this deal. All right. So this was analysis for a rental property. Let's say we want to flip this property. This is the next topic. Daniel, should we use the same property?
Yeah, let's use it because I'd be interested to see how it'll perform if you were able to vacate all of the suites and maybe spend $25,000 or $50,000 per unit renovating, and then selling it out. I have some estimates on what the rents would be, and then what we would sell it at a 5 cap, or maybe a 4.5 cap, since it'll be like a perfect, almost brand new unit.
All right, let's try. So I will take the address. Okay, so we are going to purchase in 2 million.
Yeah.
Okay, improving cost. By the way, in a flip deal, I can break down the costs. So basically, you have a list of your costs. Might be more accurate. So if you want to replace the kitchen, you can put like the number for each item, and then save
Nice.
it, have it on the deal. But just for this case, let's put like a high level number for the refurbishment. How much you're going to invest in order to improve the property?
Yeah, I would say probably, I think probably 50,000 per suite would be reasonable. So I guess like 250 grand.
Okay, it will include the furnishing, or you want to put like a different number for that, or?
No, that should be okay. I think we can leave that one.
Right, no problem. Okay, the closing costs, let's add, I say legal fees, what, 1,500?
Yeah, about that. So I would the appraisal cost I would probably do ×2, because you're going to need an appraisal on the way in and the way out.
So 15 as well, or more?
Yeah, 1,500 is good.
Okay. Let's put some buffer here. All right. Okay, so the entire purchase cost is 2.3-ish. Then let's speak about leveraging the flip deal. So the interest rate will be higher. We take it on a monthly interest rate because you will see that the project is basically in months. So first, what is the maximum loan to value we'll get for a flip project?
You could probably get 80% loan to value.
All right. So we need to put down 731K. Monthly interest, I would say 0.8 is around 10% a year. So we can keep it like this, yes?
Yep.
Would you pay arrangement fee in Canada?
Yeah, let's say maybe because you're trying to get some private capital, maybe even you crank up that interest rate a little bit, like make it yeah, I guess 8 or 1% a month kind of thing.
Okay.
And then you'd probably pay a broker fee of 1% of the loan amount, so $7,000, let's say, on the arrangement fee.
The arrangement fee, you mean the arrangement fee?
Yeah, it should be 1 or 2% of the loan amount typically. So 7 or
yeah. So if it's
maybe 14,000 in the worst case.
2% with 30.
Or sorry, yeah, the loan. Yeah, so sorry. Oh yeah, you're right. Yeah, you have
Yeah.
it there. Sorry, my apologies. I was using the cash number.
And if you're going to pay broker fee as well.
Well, that would be the arrangement fee. Like the broker, a private lender, typically a private lender or broker would typically pay would be charging that 2% fee.
All right. During the project, you are going to pay any monthly costs.
Yeah, I would just basically say you have to have property insurance on it. There shouldn't be any maintenance, and the utilities should be minimal because nobody's in it. So maybe put the utilities at $250 a month and insurance at $250 a month.
Right. Okay. How long you think it will take you to make the improvement and sell the property?
I would say probably if it was me, like I'm also going to stabilize the property. So we're going to renovate all the suites and then we'll put new tenants in at the increased rent. So let's say 12 months just to be safe. Give ourselves enough time here to make sure that we can actually execute this deal.
Okay. And what will be the sale price?
I think the sale price would be, I have it at, like, if I've increased all of the rents, basically doubled all of the rents, which you should be able to do given where they're performing, at a 5% cap rate, it would be just over 3 million. So you can put $3 million.
All right. Agent commission, it's more than 1%. So
yeah, I would probably make the commission probably 4% total.
All right. Any other sale costs, or you include it on this 4%?
Just a discharge lawyer, so maybe $1,500 on the sale as well.
All right. So the summary of this deal: you're going to invest 731 in cash to make a profit in 12 months of 438K. This is the gross profit. The net profit. Net profit is basically after you pay the commissions and the other sale costs, or like 300-ish K, and the hour is 42%. What do you say about this deal? Looks good. So
I like it. Yeah, I like it more. I like it more as a flip than I do as a hold.
Absolutely. I think on the rental, you would get this return just after many years. So, okay, interesting. But I think that in order to flip property, you need the relevant experience, like a good team for that.
Yeah, you definitely do. You need to be a pretty skilled executor to do that, to do that well.
It's more complicated than just buy a property and let it out.
Yeah, for sure.
All right, here as well, you can use the prospect page. Yeah, we speak about the premium in a sec, and review the summary of this deal. And yeah, so this was like high-level overview about how you can analyze rental properties and flip projects using Landlord. Let's go back to the agenda. Okay, so Perhaps some tips from you, Daniel, about how you source properties and how you analyze properties. So we just showcased how you analyze properties, but I think like if perhaps few words about this current market situation. You mentioned it in the beginning that might be now opportunities, or if we look at 2023 as well, how
Yeah.
do you see it, and how is like the way you look at um, property deals right now, and what is your approach these days?
Yeah. Yeah. So really right now, I'm focusing on scale and agility. So, we're willing to invest in most markets across Canada as long as the rate of return is good enough. And as long as we can get enough units to make it worth our while to hire a property manager. So one of the things I'll do is I'll actually just go to realtor.ca and I'll zoom out and look at Canada broadly, or a province that I might be interested in, to find a market that I like. And if somebody's looking to, if you haven't decided in what market you want to invest in at all, we do have a report that we actually did with Lendlord. So we used Lendlord to analyze hundreds of properties across the country, and I'll post a link to it in the chat once I'm done speaking, so that people can sign up to get that. But basically, we used Lendlord to look at hundreds of deals across the country through this deal analyzer tool, and basically found the lowest and highest cap rates in each city. We had 21 different cities across Canada. And then we also put what's called the rent to price ratio. So that'll allow you to kind of say, okay, I know St. John's and Saskatoon, as an example, have the highest cap rates. And so I'm going to start looking in those areas. And then, okay, I know I want to buy, I need to buy a fourplex to make the scale make sense. So I'll go look at every fourplex available in St. John's or in Saskatoon. Once I've done that, and I've kind of clicked through to look at, let's say, 10 different properties in the market, then I basically just go through and start plugging them all into Lendlord's Deal Analyzer. And I save them all as prospects, and I start comparing them side by side, and I send them to my investors that I'm working with. And it takes that to see I think that the market right now, we're seeing what I would call a counter cycle in Canadian real estate. So last time we saw a major cyclical event like this was in 1991, right? 1989 was the last kind of big peak, let's call it, in Canadian housing. What happened was house prices crashed about 20%, 25% in a couple of months. And then they slowly grinded down over the course of 3 to 4 years. And you want to be buying in that 3 to 4 year period when everybody else is scared and nobody else knows what's happening. And to me, we're in that period right now. And I'm personally of the opinion that the market will probably fall another 10 to 15%, but I'm still out there actively buying. We took a couple of properties under contract last week. We took a couple of properties under contract a month ago. And even though I realize that risk is there, I buy properties that have, minimum of a 5% cap rate. We're typically targeting a 7 to 8% cap rate. And so in the 2 years that I've held the property, I'll already, I'll earn back that potential risk that I could realize on the price. And the reality is I plan to own these. I want to be collecting rent checks during that downturn. I don't want to be having to worry about timing the market or whatever it is. And so right now, it's not that I'm in a hurry to buy anything, but if I'm in a hurry to find a good deal, and if I can find a good deal, if I can go through that process, then I'll execute on it. The last thing that I'll leave everyone with is that, as price goes down, your risk gets lower, because, the lower prices get, the less risk there is below you, the closer you are to the bottom. The higher prices get, the less, or the more risk there is below you, and the less upside there is above you. And everybody seemed to be so excited to rush into the market when in February of this year, when prices were going crazy and there was very little upside and a very high downside. And now all of a sudden, nobody's lining up to try and do deals when prices are coming down because people are scared. I think, if you look at, Charlie Munger said it, or maybe it was Warren Buffett, but, be greedy when others are fearful, and be fearful when others are greedy. And so I think you have to give yourself the tools to do that. And I can analyze now 100 deals in a day, when before I wouldn't even think of analyzing 100 deals before. Right. So So that's, it's take a look at, you got to be looking at hundreds of properties and then putting out 10, 20 offers and being willing to walk away from the ones that you don't get. That's what it takes to get a good deal in this market, I think. But they're out there. The good deals are out there in today's market.
Yeah, sounds good. Just technically, how the way to do it is just like analyze the deal, click save, and then on my portfolio, you will have your entire prospect lists, and you can just, so let's say you mentioned the cap rate as the main metric.
Yeah.
So just
So
the cap rate.
exactly. Yeah. I think you can move the columns too, can't you? Because I remember sorting by cap rate or something like that so that I could literally just look through the deals and see which ones were.
Yeah.
Yeah.
Where's the cap rate? Okay. Yes. And then you can see this is top down. So you can see you have 7.18, and then you can just visit again this deal.
Yeah.
And yeah, so basically this is the best one that we currently have on this pipeline. So yeah, so it's a great way to analyze deals, save them, and then use the my portfolio page with your prospect properties checked in order to compare. You can just need to uncheck your existing properties. All right.
I just saw a question there in the chat that Adrian mentioned. Do I choose based on cap rate, even if it's negative cash flowing? I won't buy anything that's negative cash flowing. I guess to quote Warren Buffett again, rule number one is never lose money. So, yeah, so that would I always aim for a 7 cap, and it shouldn't be negative cash flowing at a 7 cap based on the loan to value that we're buying at, which is 70% loan to value. So you got to think about the levers that you have in the cash flow and like the different metrics, right? So if you're cash flow negative at a 7 cap, then your loan to value is too high, or your interest rate is too high. And so you need to change one of those variables. And then you kind of reverse engineer from there how to, like what element can you reduce? Can I reduce the price? Can I increase the rents? Can I decrease my interest rate, or or some other variable, right? But yeah, I won't buy. So I typically aim for 7 cap and break even at a minimum. We do like a little bit of positive cash flow, but it's not our primary goal.
Yeah. This is, by the way, just some fake numbers I put. So it looks now it looks much perhaps more close to reality.
Awesome. Yeah, thanks for the feedback, Connor. Really appreciate it. Nick and I would love to even come in and meet your class sometime if you want. Just send us a message.
Yeah, so you look at the chat. Yeah, okay. So yeah, I think that we have 1 minute left, but perhaps just if there are questions, perhaps we can answer a few. So let's see on the chat. Are all these features free on Lendlord? Good question. So the core functionality is free. You can analyze property deals for free. You can manage unlimited properties and unlimited tenants for free. We do have a premium plan, and the premium plan contains, if you want to link your bank account, let's see if I can show perhaps here, then we use Plaid as a secured connection. I'll try to do it from here, and you can link your bank account, get a live feed of your transactions, and then easily you can just allocate them to the relevant properties. And this is a great way to assess the performance of your existing properties. This is a test environment, so you connect. Okay, so I will not do it right now, but basically after you link your bank account, on the transactions page, you will be able to allocate transactions to properties. We did a webinar on that. Perhaps we'll do another one. The result of that, and I love to use the interactive report. So you can get a report of your existing properties, the entire portfolio. So you can see that development of the equity over the years, what is your the entire portfolio loan to value, and how much equity you have. So let's say if I take the loan to value to 70%, how much equity I can release. Some information about the performance of the entire portfolio, and highlights performance of properties that were like outperforming and underperforming, You can also review your prospect properties here. And then you can go property by property and see the metrics. You can see the rank of this property if we compare it to the other properties. So it's a very useful way to review your portfolio, this interactive report. So under the premium plan, we have the linkage of bank account. And also if you want to generate reports, also it's under the premium plan. And also if you want to manage your documents is on the premium plan. We are still thinking about the price. It's currently $25 per month, but we might reduce it very soon. And people that sign up through your link, Daniel, that I think that we put it on the chat, will get, I think it was 3 months.
Free. Yeah, I think it's three months free. Yeah.
Yes, for the premium plan. So feel free to use the link of Daniel. We will put it also on the description of this video. And then you will get this benefit. And it's a great way to start, to get started.
Yeah, for sure. Just to answer the two other questions there, Kim mentioned, do we have benchmarks that are considered ideal cap rates by major Canadian city? So we did do a report on this using the Lendlord tool, as I had mentioned. And so we tried to create, it's hard to get a singular number for each, but we do talk about it on the podcast a lot. We use what's called the rent to price ratio rather than a cap rate because it's easier to measure the broad market. It doesn't, it's hard to know what cap you should be targeting in each market based on that. But typically, if you check Collier's cap rate report, they have cap rates for multifamily assets. And if you can outperform those by about 25 to 30%, then you're typically doing okay. And I did also just post a link there. You can see the chart, the headline chart of the average housing market investment returns in that link to the report. And we used Lendlord to come up with those. So basically, what's the lowest cap rate in each city? What's the highest cap rate in each city? And then you'll see a triangle on the chart. And that triangle is the rent to price ratio there. Sort of the same thing for Dean. It's really tough to create a central database where we have cap rates for every CMA or postal code area in the country. Although it would be cool, if we could do that eventually, where we can plug in listings from realtor.ca as an example. And as long as they have the income somewhere in the description, it would, we could probably try and do that at scale.
Yeah. By the way, there is this feature on my portfolio. You can use the map view to see let's take the existing properties to see your properties on a Google map.
Awesome.
Yes. So, and then you can see the metrics of each.
Nice.
Yeah. Do we have any other question?
Yeah, there's a couple other ones there. So Mike asked if Cornwall is still my favorite place in Ontario. I haven't. We actually just bought a 10 unit up in French River. I actually posted the link. We took it under contract, so I posted the link. It's the top link in the chat. We're going to analyze it, but I didn't have the rents. So I really like French River because you can buy at like prices north or prices that would be like for areas north of Sudbury, like you're buying at like, I don't know, like Timmins prices, but you're getting an hour closer to Toronto by comparison to Sudbury as an example. And Sudbury, so you're getting cheaper than Sudbury, but closer than Sudbury. So I do like French River, but we found that it was hard to find good deals there. And this is what I'm saying about, getting good deal or like being patient and looking at a lot of deals. Cause we kept scouring the market there, and we took a couple of properties in French River, and then we're looking at a few more portfolios in Cornwall. I like Cornwall because it's easy to buy scale. Like you can get, I think we're looking at like a nine building portfolio right now with 20 something units. You can buy like crappy old duplexes that, they're tenants that a lot of landlords, to be honest, don't want to take on, but we take pride in providing them housing. And we think, most of them are going to live out their days there, and we'll realize the upside in the investments in 20 years when that happens, or 15 years when that happens. So I think Cornwall works well from our perspective in that, it's also really close to Ottawa and Montreal, so you do get a lot of boomers moving into those areas. So I'd say Cornwall and French River are my two favorite markets in Ontario right now, Mike.
All right. So okay. So I think that's it. Daniel, thank you very much for your time. It was really helpful and interesting to analyze deals with you, and hope we can do more webinars like this.
Yeah, I'd love to.
And thanks everyone for joining. If you haven't signed up yet, use the link that we shared on the chat. We also share a link on the description of this video. So have a great evening. Thank you very much for your time.
Thanks, everyone.